Hey, gorgeous! Welcome to the Business Mindset Podcast with Holly Wharton, which combines powerful strategies on how to upgrade your business mindset along with practical business tips to grow your business. This podcast features solo shows with Holly and also interviews with inspiring women entrepreneurs from around the world. Thank you so much for joining us today. And now, here's your host, Holly Wharton.
Hello and welcome to the Business Mindset Podcast, episode 165. This is your host, Holly Wharton. I'm here with today's special guest, Linda P. Jones. After becoming a multi-millionaire at age 39 and then widowed at age 45, Linda set out on a mission to teach financial freedom the smart way. Linda's the host of the Be Wealthy and Smart podcast on iTunes, and in 2015 was named 6th best personal finance podcasters on the internet. She's been featured on TV and in various media, such as Forbes.com and Women's Day magazine. Welcome, Linda.
Thanks, Holly. Great to be here.
I'm so excited to talk to you today.
Well, I love what you're doing. I love your work, and what you're doing for women is awesome.
Oh, thank you. So why don't you start out by telling us a little bit about your background and your business journey and how you got to where you are today?
Oh, boy. Well, I started out in a small community near Seattle, Washington, and my dad was a Boeing engineer. My mom was a homemaker. I'm the youngest of 5 children. So I didn't grow up wealthy, but we were in a community of very, very wealthy people nearby. So all of my friends at school seemed to be very rich. And I mean, when I say rich, I mean they owned department stores, they owned professional football teams. They were extremely wealthy. And it caused me to wonder, why are some people wealthy and how do they get that way? And it caused me to start studying that from a really young age. I read Think and Grow Rich when I was 10 years old.
Wow.
And started about mindset actually right then, and started following millionaires and what they did and trying to figure out, how does wealth really work? At that age, it was really just because I thought if I had a lot of money, I wouldn't have any limitation in my life, and what a cool life I would live to not have to worry about money. So, but we grew up, earning our allowance by cleaning apartments, which my parents bought an apartment building. They saved and invested on the side and eventually bought an apartment building. And so my brothers and sisters and I would paint the apartment. I was the youngest, so I'd do less difficult tasks. I'd vacuum and take down the draperies for dry cleaning and things like that. But that's how we earned our allowance. So we were paid to actually work, and that's how we earned our allowance. Then I went to college, got a business degree, started working for a Wall Street firm when I graduated because I wanted to, again, find out about investing and money. Became a certified financial planner so I could learn more about money. And I started representing professional money managers. Those are the people that your financial advisor puts their clients' money with. And I learned all about what successful investors did. But while I was doing that, I was getting the message that the individual investor should not try to invest on their own, that they should only use professional managers. And the reason was it was too risky. People can't do it themselves. It's too difficult. And this was the negative message that I kept getting. So I bought into that for a while, and I invested in real estate and did well, but I thought, I'm learning the power of compounding and how important that is. And I think it's going to take me forever to build wealth this way. So I need to look for something else. And I noted the stock market had gone up about 30% in a year. And I thought, wow, that's a lot easier than real estate. And so at least, it would be if I could figure it out. And so I bought the book, How to Make Money in Stocks by William J. O'Neill, who's the founder of Investors Business Daily newspaper. And I started following what he said. And I also lucked into the cycle of investing in technology stocks and internet stocks in the late 90s. And so the combination of buying individual stocks and having a bubble to invest in meant that I created $2 million by the time I was 39 years old. Well, I sort of developed my own style from what he said. I sort of honed it down to a shorter formula, but I really just followed what he said. And he taught me that you want to buy companies that have increasing earnings at an increasing rate. So what that means is that they're very profitable. They're making more and more money each year. And those are the kinds of companies that make good investments. So once I could follow companies that were very consistent with their profits, I could invest in those companies. And it just, kept working, and I kept honing my skills. And I didn't always, it wasn't perfect. I made mistakes. I lost money along the way, but I also could turn it around and keep going and learn from my mistakes and get better and better and better at it. And so finally, all of that experience just served me to finally, have a lot of success at it.
Now, how time consuming was this? How much time did you have to spend every day or every week paying attention to your stocks?
That's a great question. A lot of people don't ask me that. And it didn't really take that much time. I mean, the thing that I did, though, was I woke up early every morning and I would study and look at the market and decide what stocks I wanted to buy or sell early in the morning before I went to work. But I was holding down a full-time job. I was traveling. I was on the road. I didn't have a lot of time to really be devoting to this. I had to sort of, watch it when I could. But it didn't take a whole lot of extra time. Most people think investing takes so much time and it's just going to be so overwhelming. And it really doesn't. You can just kind of make an investment and then fine tune it as you go along. So it wasn't really that bad.
So is this the kind of thing you can do online now? You just have a website where you go in and you adjust your stocks, or do you still need to go through a real human being?
Oh, absolutely. You can do it online. I mean, I'm fine with financial advisors. I've used financial advisors and I've also handled some of my portfolio myself. So it just depends what you want to do. But I think the average everyday person definitely can invest for themselves. And I actually created a community around that called the VIP Experience, where I teach people what's going on and do a webinar once a month, talk about what's happening in the markets and what they can invest in. So I give people advice about where to invest and where to find, what's going on right now, because the traditional investment world pretty much invests the same way all the time. And you can go to an advisor in Philadelphia or you can go to one in LA, and they'll probably give you very similar investment advice. But you might be missing what cycle is happening right now. What is the next bubble that's forming? What do you want to stay away from? What do you want to get into that might be a multi-year cycle that's just about ready to happen? And, for example, this year, the stock market's up roughly 3.5%, and we're in some things that are up 42%. So by being non-traditional and looking at things a little different, there are ways to build wealth.
Excellent. So what kind of mindset do you think people need to go into this kind of investing for the first time? Because I think it can be really, really scary for people who are just getting started and doing it on their own.
I totally understand that. I was terrified. I mean, I thought I would lose all of my money, and I thought, it was too hard. I mean, I bought into all that. They really, I was really scared from what Wall Street had told me, that it just wasn't possible. And I just over time developed more confidence. I think like anything, you have to start slowly and you have to do a little bit at a time. Maybe people could just start with a small account that's online and just try experimenting a little bit, but get tools and get education. Don't try to just guess. Don't go by tips. That's a mistake people make. I think that people need to, like I did, read and learn from a mentor and find a system that's going to work for you.
Now, when you say to start small and kind of build your way up, what is the minimum do you think people could use to really start small but start playing around with it and learn with their money?
What's so funny, Holly, is people always think that it takes a lot of money to start investing, and it really doesn't. You can start with as little as $25, honestly.
Wow.
But I recommend people maybe have $1,000 to get started. I actually did a podcast about how it doesn't take much money to get started investing if people want to listen to that. But it really doesn't take as much as people think, because nowadays we have things called exchange traded funds, which is a terrible name because it doesn't tell you anything. But what it means is that there's a group of companies that you can invest in. So you're investing in a whole pool. You're not just investing in one company. And that means you can be diversified for a very small amount of money. You can buy a percentage of all of these companies. So you can have diversification even if you're investing with very little money today.
Sounds interesting. So we decided we were going to talk a little bit today about what you call the 6 steps to wealth. And I find that really fascinating. I love STEP programs. So why don't you share with us a little bit about what your 6 steps to wealth are?
Sure. Well, remember I was saying that I was really curious how some people are wealthy and why some are and why some aren't. And this really is my answer to that. This is really what I believe is a step-by-step system for anyone to create wealth. And what I think the traditional financial world misses is step 1, which is creating a wealthy mindset, which is interesting that we're on your show, since I know you really value mindset. And it's something that, we're grown up with negative talk about money when we're children. We're told by our parents money doesn't grow on trees, and they mean well, but sometimes we get a negative message around money. It can be around scripture and at our church. It can be, from any number of different areas. And so what I realized is that people that had a lot of money really worked on their mindset. And you get this.
Yeah, I like that.
Yeah. And they, first of all, wealth begins with a decision. It doesn't just happen to you. Most people who become wealthy decide they want to be wealthy. And that is an important distinction, is that people make that decision that they want to be wealthy. And secondly, that they, invest the time and energy to find the way to do that, to get educated, to find mentors, to, just like in business, if you want to be successful in business, it doesn't just happen to you.
You've got to learn and you've got to have support.
That's right. And there's a lot to know as an entrepreneur. I mean, I've been surprised as an entrepreneur myself how much there is to learn and how it's ever evolving and changing as technology and social media and things like that change. But people really need to work on their mindset and their positivity, because we put a lot of limits on ourselves. We sometimes lack confidence in ourselves and what we can really do, and that holds us back. Recently, I was talking with someone who is a business mentor. He's kind of like a mini Warren Buffett. He's buying percentages of companies. And he and I were talking, and he just said, I've been surprised that the place where business owners really get stuck is in mindset. And I said, it's really interesting you say that, because the 6 steps to wealth starts with creating a wealthy mindset. I think it's in everything we do. Thought is so powerful.
Oh, yes. So powerful. And if we're feeling sorry for ourselves, poor me, I just never have enough money, I'm not making enough, never have enough to, just barely sliding by, that just brings you down in a spiral. And that's definitely not going to be helpful in creating wealth.
That's right. And anytime we focus on the negative, we're just bringing on more negativity. You can focus on what's possible for you. Let's say that you can imagine that there are different levels of success that you can have. And if you could imagine the highest level of success that you could have, if you can just focus on that image of yourself, that would be so much more powerful than letting fear get a hold of you.
Yes. Even if you just did that for a couple minutes every day or even once a week, that's going to be better than focusing on all the bills that you have to pay.
That's right. Absolutely. So that's step 1. Step 2 is to save a nest egg. So people have to eventually come up with something to invest. And so you need to pay yourself first, like we've always heard. Make yourself as important as all of your bills and give yourself money first that you can set aside. And, I think people sort of get this one a little, I don't want to say wrong, but, there's this whole movement that you have to be frugal in order to build wealth. And I just don't believe that. I think that I have a funny saying, which is that budgets can be hazardous to your wealth.
Yeah, I understand that.
Yeah. And it's because it feels like a diet and it feels like it's restrictive. You want to go off it as soon as you're on it, and it can give you a bad relationship with money. So rather than trying to restrict yourself and be frugal, you want to have spending priorities and saving priorities. And if you're matching your values with your money and what's important to you, then you're going to feel really good about your money. So saving a nest egg is super important, and that is really necessary to get you started investing.
Okay, so that nest egg could be that $1,000 that you mentioned to get started.
Absolutely.
Excellent.
Yes.
Well, that sounds easy. That's an easy figure to come up with.
And then step 3 is to find a mentor. So just like I found William J. O'Neill's book, and a lot of people go out and buy the book and then they're a little overwhelmed with some of the technical charts and things that
Not surprised.
that they see. And I think because I had an investment background, it wasn't as hard for me as the layperson, but I try to be that mentor to people to bridge the world of all this jargon and confusion in the investment world, to give people everyday terms and speak in English that people can understand, which is why I really started the Be Wealthy and Smart podcast, was to just get it so anyone can understand what's going on. But finding a mentor is important because they're going to give you a roadmap. They're going to, show you a system. They're going to teach you the ropes instead of you having to make all the mistakes yourself.
Yeah, I love that. And if you can find a mentor or someone that you trust, you've, followed them online or read their book or done their program. That's really, really important rather than just following something that you've read in a magazine.
That's right. That's right. And then step 4 is to invest in a money engine. And a money engine is the thing that's going to grow your wealth. And I don't believe there's any one right way to grow wealth. Some people are, oh, it's real estate, and other people are, oh, it's stocks. I don't think there's any one right way, but I do think that there are cycles and that money moves in cycles and peaks in bubbles. And I think that those things repeat. And the very, very successful investors in the world know that that is true. And they follow those cycles and they go where the money is. And I think that that's not the traditional Wall Street way of investing. And I think that people are getting savvier and they're finding that a money engine that's right for you is, it might be changing, and so you don't always have to invest in one particular thing.
So may I ask you, what cycle or peak are we in now?
So I think that we are in a peak in the bond market, which is, of course, government bonds. The government borrows money and people buy them and invest in them. And the reason why I think that's in a bubble is because interest rates are at a historic low. And this is not just in the US, but globally. And in fact, some countries have negative interest rates, which means that people are paying rather than receiving interest. They're paying to own the bonds, which is an interesting concept in and of itself. They do that because they're scared to be anywhere else, or they're scared to take any risk with their money. So they would put it there where it might be guaranteed by the government. So I think we're at a peak in interest rate bearing kind of investments that we've really seen a bubble there. And there's really only one way for interest rates to move, and that's up. Over time, they move in about a 30-year cycle. So we're a little bit past the 30-year mark, but cycles don't move, exactly. They move like curves, so like a wave. And so they're in a bottoming process that takes years, but I do think that we're in a bubble for interest rates. I think where are our investment opportunities? I think one of my favorite opportunities right now is in silver. And I think that silver is going to be much higher in the coming years, and that we are just in the beginning stages of silver making that advance.
Oh, that's interesting. I never would have guessed that.
Yeah, you don't hear it much. You don't hear about it on the news. You're not going to hear about it on CNBC. It's not something you're going to hear from your financial advisor. It's not something that is widely talked about.
Okay, well, thank you for sharing that. So what is step 5 then?
Step 5 is to compound at a high rate. And this is really the key step. So when I was mentioning that I invested in real estate and it wasn't compounding fast enough, the rate at which you can compound your investments is the key. And for all of your business owner listeners right now, that's so important for them to know, because 77% of the wealthy became wealthy by owning a business. And the reason why they became wealthy owning a business is because businesses can compound at rates not only in the double digits, but in the hundreds of percents and even in the thousands of percents annually. So when you look at a Google, which is, of course, one of the most successful businesses of all time, when you look at these people who started their business on credit cards and who were able to compound to become one of the largest companies in the world, that is, I don't even know what the compounding rate is for that, but I would love to know, because I think it has to be thousands of percents per year that they compounded.
Wow, that's impressive.
Yeah, it's really exciting. And people, get a little bored maybe thinking about what's a compounding rate. But when you think about things that are growing fast, that's where you want to put your money. And the faster that things are growing, the more exciting they can be. The faster a business is expanding its stores and its franchises. If you pay attention to that, that's not necessarily the only way to choose your investment, but it's something to pay attention to. If you, invest, if you like Panera bread and you eat at that store, that restaurant, maybe, that's something to check out if they're expanding quickly. Or even a better one is I buy my cosmetics at Ulta. Do you know the store Ulta Beauty?
Yeah, definitely.
Yeah. So Ulta is actually one of the best performing stocks right now. And so you can see it. I can experience it in my own life and my own experience, but I also can buy the stock and support that as a growing company. And the rate that they're compounding at is phenomenal. And you can participate in that growth by owning a stock.
I really like that because I think it makes it more personal. It's not just some nameless, or obviously it has a name, but some random company out on there in the stock market. It's something that you participate in and that you use their products, that you enjoy their products. I think that makes it more interesting and kind of more personal.
Absolutely. And that's super important for people to have firsthand experience of what a company does and to approve of what they do. A lot of people, of course, invested in Apple because they love Apple products. I certainly do. I have an iPhone and my Mac computer. And so a lot of people invested in Apple, and for a long time, it had spectacular growth, and then it's really slowed lately and the company hasn't been doing as well, and they don't really have as many innovative projects on, for the future. And so that's causing a problem right now with their growth. But when it was back in its heyday, it was really growing fast. And that's the kind of thing that will compound your money, is to pay attention to that.
Excellent. So what is step 6 to wealth?
So step 6 is to protect your wealth. And I put this as an important step because so many people, let's say during the real estate boom before 2008, so many people were leveraged. They were buying real estate and taking out big loans. They had 0% down loans. And that helped them build a lot of wealth while real estate was in its heyday and was compounding fast. But as soon as the 2008 financial crisis came, then those people that were highly leveraged lost their wealth as quickly as they made it because they maintained the leverage. Instead of getting rid of the leverage once they had created wealth, they kept the leverage. And then when the cycle turned, it turned against them. So to protect your wealth means that you don't want to lose the wealth you have. You want to make sure that you get rid of the leverage when you can and not stay leveraged too long.
Okay, that's interesting. And I think that's a really, really important point because if you have grown your investment, obviously, you want to keep growing it rather than risk it.
That's right. So as a business owner, you might be leveraged to get started. You might be using credit cards to get started or a line of credit, and that's great. And a lot of people do that and have success. But just make sure that you're paying down that debt when you have the success and you can't afford to get rid of it. It's tempting because debt actually increases your compounding rate. And this is where it's seductive is, for example, let's say just for an easy math, if you were buying a house and it was a $100,000 house and you put down 10%, and the house went up by 10%, then you would make 100% return on your money. That $10,000 that you invested went up 100%. So by having leverage, people can get to a higher compounding rate versus if they paid all cash for the house and it went up 10%, they'd only make 10% on their money because $10,000 on a $100,000 house is 10%. So here you're making 10 times by having leverage. And so people, get seduced by that leverage and the compounding rates and the wealth that they're building so quickly. And they need to just make sure that they're protecting their wealth and paying off that debt.
And so how do you know which is the point to start paying off that debt?
I think as soon as you can afford to, as soon as you have some cash flow and can start paying it down, you need to pay it down and make sure that you are paying off the debt. And then after that, creating, a surplus fund that in case, you have a couple lean years or something goes wrong, you've got some excess money, excess cash available before you think about going back into debt if you want to use it as a leverage tool and you're trying to use it as a compounding tool. But I just think that as soon as you can pay it off, you should pay it off.
I think those are great tips. So, Linda, how can our listeners learn more about you, or how can other women entrepreneurs work with you?
Well, they can go to the Be Wealthy and Smart podcast. It's on iTunes. Or they can go to my website, which is lindapjones.com, and get 11 quick financial tips to build your wealth.
Ooh, I like that. Excellent. So, Linda, do you have any business mentors? Are there any women entrepreneurs who inspire you?
Oh my goodness, yes. I've had many business mentors. I started out learning from Allie Brown. That was my first mastermind that I was in back in 2008 and just enjoyed having her as a mentor. She's been a phenomenal success in her business and a role model for women. I've worked with Lisa Sasevich. She also was a mentee of Allie's and was a fabulous mentor of mine. Cherie Keys has been a great mentor of mine as well. So yeah, I look to be a part of masterminds. I now run my own masterminds, but I love having mentors and I love learning from people who have had tremendous success.
Fabulous. So, Linda, we've got your website. What social networks do you hang out on? Where can people find you there?
Oh, well, they can find me on Facebook at Linda P. Jones fan page. Mm-hmm. They can find me on Instagram at Linda P. Jones. And they can find me on Twitter at Linda P. Jones.
Excellent. Great. Well, thank you so much for joining us today. Your tips are fantastic. I think you have a really clear system, and I look forward to signing up for your podcast and subscribing and listening to your tips, because I think you have a great approach to wealth.
Thank you so much, Holly. Appreciate it.
You're welcome. Thank you so much. And thank you for listening. And remember to visit hollywharton.com/165 for the show notes on this episode.
Thanks so much for listening to the Business Mindset Podcast with your host, Holly Wharton. You can find more information about today's episode, including links for topics that were discussed at hollywharton.com. And if you enjoyed this episode, please remember to head over to iTunes and leave a quick review of this podcast. It just takes a minute. Thank you.